Hello friends, let me take you through the debt market outlook for September 2023. Now starting with the US market, the US CPI for the month of July 2023 came in at 3.2%, lower than the market expectation. The month-on-month increase was at 0.2%, indicating an annual inflation rate of approximately 2.5%. Core inflation numbers are also trending lower, came in at 4.7% as against 4.8% for the previous month. Now with the US Fed fund rate in the band of 5.25, basically the midpoint at 5.35, real rates are now approximately 65 basis point over, let's say, the core CPI inflation in US. We saw some weakness in the data in US. The second quarter GDP numbers came in lower at 2.1%. There were fewer jobs opening, and the unemployment rate also jumped up from 3.5% to 3.8%. Now, given the softness in the growth data and the view that core CPI inflation is likely to trend towards 4% by end of calendar year 2023, we don't expect Fed to hike rates further in calendar year 2023. The US 2-year bond was flat on a month-on-month basis at 490, largely trading in the band of 480 to 510. However, the US 10-year bond yields were higher by 15 basis points on a month-on-month from 396 to 4.1%. And it also touched an intra-month high of 4.35%. The expectation of Fed staying higher for longer, US rating downgrade, higher supply of longer duration bonds led to the spike in long-term yields in US. Core CPI inflation in US is likely to trend lower towards 2.5% in second half of calendar year 2024. Hence, we expect Fed to start cutting rates from March or April of 2024. And Fed is likely to cut rates by approximately 150 basis points till, let's say, June 2025. Coming back to India, we had the RBI policy on 10th August 2023. RBI kept the rates unchanged, and the MPC stance was also maintained as withdrawal of accommodation. The governor said explicitly that the MPC can look through perishable food price shock for some time, but recurring shocks may be a problem as they may pose risk to anchoring inflation expectations. Hence, according to us, for now, RBI is in a wait and watch mode. However, also in order to reduce the surplus liquidity in this system, RBI asked banks to maintain 10% incremental CRR on the deposit growth between 19th May and 28th July 2023. This ICRR has reduced approximately 1,05,000 crore liquidity from the banking system. This is a temporary measure, and RBI is likely to review the same on its September 2023. We don't expect RBI to completely roll back the ICRR, and RBI may continue with partial ICRR till October 2023 policy. Now, the inflation number for July came in higher at 7.44% as against market expectation of 6.5%. CPI ex wages was, however, lower at 5.4%. Now, out of the 2.6% month-on-month increase in CPI, approximately 2.35% was contributed by vegetables, and approximately 1.35% was solely due to tomatoes. In February 2023, when RBI had hike rates, the CPI ex veggies was at 7% as against 5.40 for the month of July. Core CPI inflation came in lower at 4.9% versus 5.2% for the previous month. Government is also taking action like banning exports, introducing export duty, and by selling in open market to control food inflation. We have seen tomato prices cooling off in the month of August, and vegetable prices are likely to cool further in the month of September 2023. We continue to expect RBI will look through the spike in food inflation, and the drop in core inflation should give comfort to RBI to stay on hold in the October policy. However, RBI will continue to keep liquidity tight in the system. The short-term rates have stabilized after inching 10 basis points higher post the ICRR hike. 10-year GSEC was largely flat on a month-on-month basis, broadly trading in the band of 715 to 725. Core inflation is likely to trend lower towards 4.5% by December 2023, and once the food prices cool off, the headline inflation is also likely to trend lower, and we expect the headline inflation to be in the band of 5 to 5.25 in first half of 2025. We continue to expect RBI to cut rates by 50 basis points next year, following the US Fed pivot starting April 2024. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.